Okay, let's dive into a really strange situation happening in the silver market right now. Something that kind of defies basic logic is going on. You've got the digital version of an asset, right? And it's trading for way, way more than the actual physical thing it's supposed to represent. How does that even happen? So, first, just take a look at these returns. Since the beginning of August, physical silver on the MCX has had a fantastic run, up almost 38%. Awesome, right? But then you look at the silver ETFs. These are the funds designed to perfectly track that price, and they've shot up by a staggering 58%. And that gap, well, that's where our whole story begins. And here's the mystery in cold, hard rupees. The price for physical silver on the commodity exchange is hovering around 1,52,000 rupees. But if you go to buy that same silver through certain ETFs, you could be paying closer to 1,75,000 rupees. So what's the deal? Why is digital silver trading at such a massive premium over the real thing?
Right. So this price disconnect has created a situation that's, both a huge risk for some investors and, believe it or not, a hidden opportunity for others. Let's unpack that. Now, this table shows just how crazy things have gotten. On October 9th, the price of actual silver fell by over 2%. You'd expect the ETFs to do the same, right? Nope. That same day, the ETFs didn't just ignore the drop, they actually went up. Some by 4%, one even jumped 8%. They're literally moving in opposite directions. That just shouldn't happen.
So what does this all boil down to? An average premium of about 15%. That's how much extra you're paying right now for the convenience of an ETF, and some have even hit a 20% markup. Look, this isn't some small fee, it's a massive bubble sitting right on top of the asset's real value.
So the big question is, why is this happening? Well, it's a classic, almost textbook case of a massive demand and supply squeeze. It's really created a perfect storm in the market.
Okay, first, let's look at the demand side, because it has just exploded. You've got industries needing silver for EVs and semiconductors. You have investors piling in to hedge against all the market volatility. Then you've got the seasonal festive buying for Donteras. And to top it all off, a huge wave of retail investor FOMO, the fear of missing out. It's a total frenzy. And this quote right here, it just perfectly captures the supply problem. The people who run these ETFs, the fund managers, they have to buy physical silver to back every new unit they create. But with demand this high, they literally cannot get their hands on enough of it. So this bottleneck means the price of the limited existing ETF units gets bid up way, way beyond the actual price of silver. Okay, this brings us to a really critical warning for anyone, and I mean anyone, thinking of buying into this silver hype right now. Let's just be direct about this. This is a quote from market educator Pushkar Raj Tucker, and it couldn't be clearer. Your loss is certain. It's a stark warning, for sure, but it's based on some simple, undeniable math. So why is a loss so certain? Well, because if you buy one of these ETFs today, you are not paying the market price for silver. You are instantly paying a 15% premium. You're basically starting your investment already in a 15% hole. Now think about this for a second. It means that even if the price of actual silver stays completely flat, doesn't move a single rupee, your investment will drop by 15% the moment this whole supply-demand mess gets sorted out and the premium collapses back to zero. You could lose a huge chunk of your money without the underlying asset moving at all. But here's the twist. This strange market chaos isn't just a risk. For people who already own silver, whether it's physical bars or in an ETF, this situation actually creates a rare and pretty powerful opportunity. The strategy is called arbitrage. It sounds kind of fancy, but it's basically just a term for taking advantage of a price difference between two markets to lock in a risk-free profit. You're basically buying and selling the same thing at the same time to capture that price gap. So, for those of you holding actual physical silver, the play is to sell it at today's inflated market price. At the exact same time, you buy silver futures contracts on the commodity exchange at the lower correct price. So you still own silver, but you've locked in that price difference as an instant profit. And the very same logic works if you're holding silver ETFs. You can sell your inflated ETF units for that 15% premium and immediately use the money to buy the correctly priced silver futures. You've just traded your overpriced asset for the same asset at its fair value, and you get to pocket that 15% difference. Now, a huge word of caution here. This is an advanced strategy. It is not practical for most retail investors. Trading futures means buying in large minimum quantities, or lots,
And you've got to factor in taxes and all the transaction costs. It's really a professional's game, but it perfectly shows how markets eventually find a way to correct these kinds of imbalances.
So, after all that, what's the big lesson? What should we take away from all this market madness? This whole situation is a perfect textbook example of something called the hype cycle. And it's a pattern that you see again and again and again in financial markets, with pretty much any asset you can think of.
This timeline really shows how the cycle plays out. The best time to buy, it's often when no one is talking about an asset, when it's quiet, maybe even trading at a discount. And the worst time, well, it's when it's all over the news, everyone is euphoric, and premiums are through the roof, which is exactly where we are with silver today.
So let's wrap this up with the key takeaways. First, and this is a big one, don't buy an asset just because of media hype. Second, always understand the difference between an asset's price and its value, especially when premiums are involved. For long-term wealth, systematic investing is just way more reliable. And finally, remember that precious metals, they should really just be a small 5 to 10% slice of a well-diversified portfolio.
So I'll leave you with this final thought. Now that you can clearly see how a hype cycle works and you understand the danger of paying a huge premium, how is this going to change the way you approach the next can't-miss investment opportunity that's all over the news?